So in my last video, we learned what a recession is, and we saw that we are currently in one. In fact, one of the most severe ones yet, according to statistics. We had a record fall in GDP in the most recent quarter to June 2020. We have a record low Bank of England base rate, and we have inflation, which is way below the Bank of England's 2% target. So with all this in mind, the question is, where is good to invest during a recession? Now, a bit of wisdom, guys. Before you start looking at investing, your number one priority should be survival first, guys. We all need to be able to cover our basic food, drink, and shelter needs. So if you haven't already, the first place that you want to invest is in a nest egg, savings, rainy day fund, whatever you want to call it, to cover you for at least 3 months.
I'll drill y'all.
At least 3 months, so that you're able to cover your costs in the event of an economic downturn like what we're in right now. You might also want to make affordable offers to pay with your creditors, guys. And then only then, once those things are done, once that's all in place, guys, then you start to look at how to invest during a recession. So let me start by saying investing during a recession is a good thing to do. Investing ain't just for Christmas, guys. And when you look at the statistics, the rich tend to build significant wealth during recessions. Now, how do they do that? By accumulating assets while they're cheap, guys. Savvy investors recognize a unique buying opportunity that exists because assets are for sale effectively at deep discounts during a recession or an economic downturn. So, for example, in October 2008, Warren Buffett published an article in the New York Times declaring that he was buying American stocks during the equity downfall that was brought on by the credit crisis back then, if you remember. Now, him doing this was a derivation of buying when there's blood in the streets, guys. You might have seen his famous quote, which is, "Be fearful when others are greedy, and be greedy when others are fearful." Which basically means that whilst everybody seems to be being greedy and the sun is shining and hay is being made and they're piling money into a certain asset or opportunity, that's the time to step back and think, hey, am I investing into a bubble right now that's gonna burst soon? Are we approaching, or have we already reached the peak of returns for this particular asset, and are you actually investing into the winner's curse versus buying into a particular asset whilst nobody's talking about it? So take Bitcoin, for example. This isn't advice to buy Bitcoin now, but if you remember probably about 5 years ago or even longer back than that, when nobody was talking about Bitcoin and it was selling for under $1, right? And then you fast forward to the end of 2017, or maybe it was 2018, one of the two, guys, and it's peaking at $20,000 per Bitcoin. So imagine if you'd have bought Bitcoin, 5 to 10 years before that, when nobody knew what it was, nobody was talking about it, at under $1, and then you see that parabolic rise to $20,000, right? Other examples are one that we've all seen at some point in our lives, when somebody's talking about having bought a property in an area 15, 20, 30 years ago, when prices were the cost of a packet of crisps, and now houses in that particular area are going for hundreds of thousands of pounds. So that's what I mean by timing, guys. You want to buy something when it's low, when nobody else wants it effectively. So let's look at some simple steps. The first step is to be ready. When you stay ready, guys, you ain't got to get ready, okay? And to do this, what I personally do is I keep abreast of economic news and keep an eye on what's happening in the markets that I'm interested in, okay? The media love to scaremonger, guys, so they'll take every opportunity to report on something negative. So where there's negative GDP, where there's unemployment, where prices are falling in property, when the stock market's falling, guys. So it's very hard to miss this, and this is a great indicator, guys, to buy into these particular asset classes when they're struggling, guys. And that is one of the key strategies that Warren Buffett uses. The second part, guys, is to stay liquid. And by this, I mean have cash on hand to buy these assets when they become distressed and they're available for sale at deep discounts during these types of times, guys. Otherwise, you're just window shopping effectively. So now let's look at which assets you might want to look at buying during a recession, okay? The first is stocks and shares, guys. Stocks and shares are units of ownership in companies, and companies tend to struggle during recessions. Why? Because people aren't earning as much. They've lost their jobs, guys. They're not confident and they have a less optimistic outlook on the future. So they're less likely to go out and splurge on, say, a new car, new clothes, going to events, luxury goods, etc. And as a result, the companies selling these goods and these services lose income, okay? They lose their value as well. And you see this through their shares declining in value and becoming cheaper, guys. That's it in a very high level nutshell. And just for you guys to know what's going on in my personal life, I increased my purchases of stocks and shares during the coronavirus pandemic. I have a monthly standing order which buys into a diverse range of ETFs. If you want more information on ETFs, check out my YouTube video on how to invest and how to choose a fund. And on top of that, I bought into some additional stocks and shares because I saw discount opportunities, guys. And just to give you an idea, those investments, those additional investments that I've made, have earned me a return of 11% over the past 4 months alone, guys. And that's an excellent return by most standards, okay? So you'll see tons and tons of news articles during a recession or in the lead up to a downturn telling you that the stock market is experiencing drops, record drops, it's crashing, etc. Everyone panic. And the key is to not get guided by the news cycle, but by the historic stock market trends and your own research, guys, on what's happened historically. And the historic stock market trends tell us that the FTSE 100 has risen by 190% over the 3 decades since 1986, despite all of the multiple recessions which have taken place during that time. And there's been quite a few, guys, and it's likely that this will continue in the future. At least that's what I believe, guys. But yes, guys, do your own research and form your own opinions on where you think the stock market is going to go in the future. But history tells us that it rises over the long term, and in my estimation, it's likely to do the same in the coming decades. The next asset that you might want to look at during a recession is property. Property generally tends to fall in value during most recessions, and this is a great opportunity, guys, to purchase at deep discounts once again. Just like with stocks and shares, seeing a pattern here, guys, negotiation is key. If you know that prices are falling and people aren't buying as much, use this to your advantage, guys. If you watch my previous videos on my nightmare year in property, in those I tell you how I negotiated the price of a property down by £5,000 due to the economic climate we're in. I've also negotiated the price down on other properties that I've purchased, even though we weren't in recessions back then. But it's a great skill to develop, guys, and use whenever you can. And of course, when you pay a price below market value, that's instant equity and wealth for you guys. So research the right property, and buying it at a discount during a recession is a great investment in my opinion. Next up are savings. Now, unless you've been living somewhere under a rock, you know that interest rates on savings accounts right now are doo-doo, guys. We saw earlier that the base rate is at a record low of 0.1%, and this drives the rate that the high street banks are willing to give you on savings accounts, and right now they're incredibly low. So overall, now is not the time, it's not the season where we can be earning high returns from savings accounts alone, guys. It's a good place to put your money if you want it to be safe, but not if you want a return. In fact, the Bank of England policymakers have started to talk about negative interest rates. Now, we've never done that before in the UK, but why are they doing this, okay? Well, usually when governments are looking to stimulate an economy, they will reduce the interest rates to make borrowing cheaper, and in so doing, encourage people to spend their money, and that stimulates economic activity and raises GDP overall. Well, Bank of England interest rate is currently at 0.1%. We're pretty much at the lowest it can get. Now, the only way from here, guys, to stimulate spending is negative interest rates. Well, what do negative interest rates do? Well, now it actually costs you money to hold your money in the bank because interest rates are negative. So that's a super strong incentive that the government can give people to go out and spend their money instead of saving it. So we may be heading towards negative interest rates for the first time in our history ever, guys. Watch your space. Now, lastly, one area where you can potentially save a lot of money as well during a recession, which you may not have thought about yet, is to refinance your debts wherever possible, guys. From a cost point of view, whenever we have a debt, it's always a good idea to be on the lowest interest rate possible, guys, to reduce your debt repayments, of course. So during a recession, it's common to see interest rates being reduced, as we've just talked about, because the central banks are trying to lower interest rates to stimulate the economy. This is a great opportunity to take advantage of, guys, and refinance your existing debts onto lower interest rates if possible, guys, to reduce your payments, okay? So look into that, guys. So in summary, when in a recession, there are deep discounts for savvy investors to be had on stocks and shares and on property. You should also take the opportunity to refinance your debts onto lower interest rates wherever possible to save money on your debt repayments in the long term, guys. So that's today's video, guys. I hope you found it useful. If you did, consider subscribing and talk to me in the comment section below. You guys have a good week and I'll see you soon.